Uh, Hello, my dear future chartered accountants. A very good evening to all of you. I hope my voice is audible and the PPT is visible. Can you please confirm it once?
Problem number 40.
Yes? Okay, good. Thank you. Happy evening. Good evening. So we are doing consolidation. We started the full-fledged problems. Instead of doing a revision, let us do one more small problem itself. And along with that, we will also get to know the revision part of it. So come to this problem. From the information below, prepare consolidated balance sheet under IND AS 110. I think this is the problem we are supposed to do now. Okay, AB Limited, rupees XY, rupees share capital, general reserve, nothing is there. So let's ignore P&L, trade payables, AB XY, PPE, investment, inventory, trade receivable, cash in bank. AB acquired 90% of XY 3 years ago when the reserve and X and Y were rupees 1000. On the date of acquisition, XY Limited's property, plant, equipment had a carrying value of 3000 and a fair value of 7000. Remaining life of 4 years. The group policy is to measure the non-controlling interest at fair value acquisition date. The fair value of non-controlling interest in XY acquisition was 5200. Please read the problem once more for 2 minutes, then we'll do it together. Okay, so hope you read it. Not much of adjustments, so this is just a starter problem, a recap problem. We have share capital, we have P&L, no reserves analysis. They acquired the 90% of XY Limited 3 years ago when the reserves, meaning P&L, we will take it as P&L, were 1000. And only one adjustment is there, which is revaluation. So we can do directly, we don't have to do any working note for this. I mean, regular working note will do, other things are not required. So we can directly go for working note for consolidation. So have the format, how much percentage was acquired? They acquired 90%. So have the column, particulars amount, goodwill CONPL, goodwill 90%, CONPL 90%, NCI 10%. Have the format. Okay, hope you got it. Start from the share capital of subsidiary company 6000, 90%, 10%, 90% goes to goodwill calculation, which effectively is the net assets on the date of acquisition, and NCI 10%. Were 3000, sorry, 1000, and as on balance sheet date, P&L 13,000. So 1000 has become 13,000, which means on the date of acquisition it is 1000, and balance 12,000 is created after the date of acquisition. So we don't have the breakup of opening balance and all, not really required, because what we want ultimately is pre-acquisition, post-acquisition, which is available. So pre-acquisition on the date of acquisition 1000, and after date of acquisition, post-acquisition profit 12,000, because total is 13,000. So 1,000 P&L pre-acquisition, 12,000 post-acquisition profits. Okay. Hope no doubts till here. Okay, let's go further. Now, what is that they are telling regarding fair value adjustment? They had a carrying value of 3,000 and a fair value of 7,000. Book value 3,000, fair value 7,000. So the difference 4,000 is because of fair value adjustment, revaluation profit. No working note required. Directly difference is the amount. That's why we are writing it directly. So write down fair value adjustment 7,000 minus 3,000, which is 4,000. Okay, now whenever fair value adjustment comes, whenever revaluation comes, one more element comes. What is that? Depreciation. We can do directly here, or you can write the format what we used to follow. Both ways are fine. Let me tell you the amount directly first. Then if you want, I'll show you the format, or I'll show the format first. What is the plant property equipment book value? They say book value means as per subsidiary books. Subsidiary books on the date of acquisition. On the date of acquisition. It was 3,000. In the group books, it is valued at 7,000. That is why the difference 4,000 we call it as fair value adjustment. Now what we used to do next line? Depreciation. Depreciation. Now depreciation rate is not given. No problem. Depreciation rate is not given. We will follow straight line method. We know it had a useful life. How many useful life? It has a remaining useful life of 4 years. Assume scrap value 0, residual value 0. So you will have the remaining amount to be amortized over a period of 4 years. So 3,000 will be amortized, depreciated over a period of 4 years. 3,000 divided by 4. But how many years are over? This subsidiary was taken 3 years back. Now what is this depreciation we are calculating? From the date of acquisition till the date of consolidation, right? Till the date of consolidation. Till the date of consolidation. So from the date of acquisition till the date of consolidation, what is the time period? 3 years. 3 years. So depreciation per annum 3000 by 4 straight line method, and depreciation to be applied for an amount of 3 years, so into 4 into 3, so that will give you 2250, I think. Okay, now as per group books, if you follow same method, it is supposed to be depreciated over a period of 4 years and accumulate depreciation by the end of 3 years, because 3 years ago this subsidiary was acquired, so multiplied by 3, so how much you get? $7,000 divided by 4 into 3, 5,250. This net amount not required, this amount not required, so differential we get 3,000, and this is the additional depreciation. Actually we don't have to show so much of things, just to make your logic more stronger. I repeated this much calculation not required. How we can do directly? Fair value adjustment is 4,000 and this will be depreciated over a period of 4 years, and we are done with 3 years, which means 3 years depreciation is already, 3 years depreciation is post acquisition depreciation. So 4,000 divided by 4 to be amortized, to be depreciated over a period of 4 years into 3, you get the number directly. That's what I shown here. 4,000 to be depreciated over a period of 4 years, out of which 3 years are over from the date of acquisition till the date of consolidation. So into 3 by 4 you get 3,000, 90% to CONPL, 10% to NCI. So you can show this much calculation or you can write one line. Both are absolutely fine from exam point of view. Okay, there is no adjustment like unrealized profit, dividend and all, but there is one more adjustment to be considered before we move further. Can you think what could be that one more adjustment? That is, yes, NCI. Because they said NCI to be valued on fair value basis, therefore we require one adjustment for NCI. I'll give you 2 minutes. Please try computing NCI adjustment, because that is where many students usually told me they do mistakes. So you try it yourself. Let's see if you're able to do it. Okay, let's see if you're able to get it. NCI adjustment. NCI adjustment is different between the book value and fair value. Book value I mean proportionate amount. So what is the book value going to be? We consider 600. We will consider 100 because both were part of net assets, share capital also, pre-acquisition profits also. 1,200 is post acquisition profit, that will not be considered, that arose later. 400 fair value adjustment, yes, that is on the date of acquisition, we'll take it into consideration. Depreciation is post acquisition element, we don't take it into consideration. So 600 plus 100 plus 400, that will give you 1,100. And fair value is given 5,200. So NCI adjustment is 4,100. Since the fair value is high, it's going to be plus in NCI and minus in goodwill. Hope you're able to get the NCI adjustment calculation logically as well as mathematically. Then rest is not difficult. Come to the holding company, their investments 10,000, their P&L account 28,000, and see if you're able to get these amounts. 4,200, 6,100, and 6,100. Okay, hope you got it. And you please try preparing balance sheets because it's a simple problem. You should be able to do it. I'll give you 5 minutes. Prepare balance sheet, then I'll show you the solution. Please prepare balance sheets. Let's see if you're able to do. Let me show you. 5,000. I'll just show you the calculation, how it is done. PP is given 24,000 thousands. Given holding company 24,000 and 10,000. And there is fair value adjustment. Revaluation profit to the extent of 4,000 at the time of acquisition, and subsequently we provided depreciation 3,000 because useful life was 4 years, 3 years over. So that's how you get 35,000. And the intangible assets, goodwill, as per our calculation, that is 4,200. And rest everything is mere line by line addition. Inventories, no adjustments are there. So 14,000 plus 7,000. Then trade receivables 12,000, 4,000. The 16,000. Cash and cash equivalent 9,000, 1,000. That's how you get 10,000. Share capital only holding company 30,000. Other equity as per working note. NCI as per working note. Trade payables, we have 11,000 plus 3,000. Okay, so see if you are able to do it till here. If you have any doubts, please let me know. The balance sheet. Hope everything is fine so far. So now we have to look for some more adjustments. Okay, let's go further. Okay, now, so this is one of the again slightly complex area where many students have a issue. So please focus carefully. Dividend treatment. So two broad things we have to understand here. Purely from the standards point of view, what is the impact? So when the dividend is paid by subsidiary company, how it's going to affect consolidation process conceptually? That is one part. Other part what we have to understand is from exam point of view, how the treatment should be provided. That is our target. First, let's understand neither of these two. First, let me tell you how the dividend usually progress. There are three terms associated with dividends. First, dividends gets proposed in board of directors meeting. Once the year end is over, the board of directors meeting meets for discussion finalization of accounts, and one of the agenda is proposal of dividends, and then it gets declared at AGM, and after AGM dividend gets paid. So three stages of dividend payments. Just to tell you the status once more, suppose on 1/4/2017 to 31st March 2018 is the year end, 1 year accounting year, financial year. Company makes profits, financial year, year end. Then board of meeting happens on 30th of April 2018, where board of directors meet, board resolution happens, and they propose dividend. And they do the finalization of accounts for audit purpose. On 15th of May, for example purpose, AGM is held. In AGM, there is something called as ordinary business. 4 points are there, like accounts, dividends, something like that. In AGM, dividend gets approved and gets declared. And after that, the dividend payment will take place, let's say 20th of May. Okay. This is the whole process. Okay, and profit is earned during 17 days period, and dividend is proposed on 30th of April, and dividend gets declared on 15th of May, dividend gets paid on 20th of May. This is the whole process in a normal dividend payment. If you want, please copy it down, and if you have any doubts in the basics, get it clarified. I'll give you 2 minutes. If you want, make a quick copy of it. Otherwise, let's go through it. For those who have doubts, please get clarified. Okay. Hope you got this one. Any doubts in the basics? Okay. Hope the concept of dividend is clear. I'll repeat once more. On the board of directors meeting, dividend gets proposed and dividend declared in AGM or dividend approved in AGM. Now please tell me, can the dividend be declared? Listen to my words carefully. Can dividend be declared before the year end? Can dividend be declared before the year end? Is it possible? I am asking about for the year 17-18. For the year 17-18, before finalization, before board of directors meeting, can dividend be declared and paid after the year end, but declared before the year end, before the financial year ends, before the approval, before putting it to AGM? Can you declare dividend and make the payments? It's possible, interim dividend, but that is a very exceptional situation. Okay, that is possible, but exceptional situation, because before the year end, if they want to pay dividend, they'll pay it. Why will they declare before 31st March and pay after that? It does not make sense. So in the question, if they give you first adjustment in the problem, dividend proposed, let's say you are finalizing the accounts, you are preparing the consolidated balance sheet for the year 17-18 as of 31st of March 2018, and they tell you dividend proposed. What will you do with respect to adjustment? You will ignore. You will ignore. Why will you ignore it? Because as per AS4, IND AS 10, dividend proposed after the balance sheet date is non-adjusting event. So it will not have any effect whether it is dividend proposed by holding company or dividend proposed by subsidiary company. Now, what will happen if it is, they use the word dividend declared for the year 17-18? They use that term, dividend declared. So, when they say normal dividend declared, we normally say it is final dividend, and final dividend means it is should have been proposed dividend. So they will use the word dividend declared for the year 17-18. So you don't have to be more serious. Sir, how can they say dividend declared where it is yet to be approved in the board of directors meeting and shareholders meeting? So in the question, when they say dividend proposed, we ignore. If they say dividend declared for the year, on an exceptional case, it can mean interim dividend, but for exam purpose, we don't want to include that. If you want to include, what should be done? I'll discuss later. But for the examination purpose, for the discussion purpose, dividend declared also will be interpreted as dividend proposed, and that also we will ignore it. So, two adjustments are already done. Already simple, ignore. And dividend paid next year, why will we consider? We will not consider. But dividend paid during the year for the previous year, in the current year, AGM would have happened for the past year. That dividend we have to give the treatment and we have to understand. So let's write down the three things. Three things can happen. Let's say we are in the financial year 2019-20. We are in that year. What and all can happen in question? One, they say, in the examination question, they give information like this. Dividend proposed. Dividend proposed for the year 19-20. What do we do? Simple adjustment, ignored. Why will we ignore? Because it is non-adjusting event as per IND AS 10, AS4. Non-adjusting event. IND AS 10. If they give the word dividend declared, if they use the word dividend declared for the year 1920, 2019-20. If they use the word dividend declared, even then you interpret as dividend proposed. You assume, you imply, interpret as dividend declared, dividend proposed, and you follow the same thing. So that is ignored, non-adjusting event as per IND AS 10. So dividend proposed, ignore. Dividend declared, interpret as dividend proposed, ignore. But this one, dividend paid not for the year 1920, dividend paid in 1920, that is during the year 1920, related to earlier years, related to dividend paid, let's say related to earlier years or related to current year, it can be both. Let's say dividend paid in 2019-20, this we need to consider adjustments to be applied, though this requires treatment to be treated, to be considered. So summary of this discussion so far is very simple. Dividend proposed, ignore. Dividend declared, interpret as proposed, ignore. Dividend paid during the year, dividend paid during the year only to be considered. That's all what is most important point. So when a dividend payment happens, payment yet to happen, ignore it, not at all required, non-adjusting event. Dividend yet to be paid, ignore. Dividend already paid in the current year or in the earlier years, then dividend paid, the dividend payment takes place, we need to discuss that. Okay, I hope you are clear till here. Any question you want to ask, please get it clarified. Also, now let's come to this most important point, and one thing we should discuss. If you make a provision for dividend, what is the impact? Please remind me, I'll discuss at the end because they are not at all required, nowhere covered in the book, but conceptually if you want, we'll cover later. But I don't want to mix it now. So please remind me, later I'll discuss with you. And after this I should give you the balance sheet also, remind me that also. Okay. Let's understand impact of dividend payment. Let's understand in 3 books. Let's understand in 3 books. Holding company, subsidiary company, and group as a whole. And when I say dividend payment, it means dividend payment by subsidiary. That's what important. Sorry, I forgot to mention it. Dividend paid by subsidiary. Dividend payment by holding company requires no adjustment. Dividend paid, no adjustment. Dividend proposed, no adjustment. Regularly, whatever happens, you do it. Consolidation as such, no special treatment. So, holding company dividend payment is not important. We are discussing the subsidiary company paying dividend to holding company. That is what we are trying to understand. Okay, now please tell me this. Let's understand the impact first. So, dividends in general, conceptually, or on cash flow, impact on cash flow, let's say on cash flow. Holding company cash flow, what do you think will happen? It will be increasing the cash flow or decreasing the cash flow? Think only from holding company point of view, separate financial statements, independent financial statements. It will be positive impact or negative impact? It will be increased or decreased? Cash flow, bank balance.
Increase brother. Increase. Subsidies increase.
That will be positive, right? In holding company books only. I'm only talking now in holding company books. So on cash flow, this is the receipt of dividend. Dividend will be received. So cash flow means receipt of dividend, means cash flow will increase automatically. Receipt of dividend. I'm not asking journal entry, just the impact. Dividend will come in, inflow. Now, if subsidiary company make a payment of 1 lakh, will holding company receive entire 1 lakh? Will they receive entire dividend income? Definitely no. They will receive only proportionately to the extent of their share. So receipt of dividend proportionately to their share. Proportionately to the extent of their share. Now for subsidiary company, what is the impact? It is the outflow of dividend. So payment of dividend. Payment of dividend. Now tell me what you should do from the group point of view. What do you think will be the impact on the group when holding company pays, when subsidiary company pays dividend to holding company is also in the group, subsidiary company also in the group. For holding companies, dividend is coming in, for a subsidiary company, dividend is going out. For the group, what is going to happen? Impact. I'm not at all asking journal entry. Please don't tell about journal entry. I'm not asking journal entry. I'm asking about the cash flow impact. No impact. Are you sure? No impact. Yes, the payment of dividend, let's say 1 lakh happens, and the dividend received by holding company will be, let's say, 80,000. So 1 lakh paid, 80,000 received, happens adjustments. Balance 20,000 will still go out of the group. So payment of for the group, payment is here. For subsidiary, payment of the group, payment of dividend fully. But for the group, payment of dividends to the extent of NCI only. To the extent of NCI only. So only to the extent of NCI share, the group cash balance will come down. So hope you understood the impact of cash flow. Okay. Now as far as the journal entry is concerned, what entry to be passed by holding company? They will receive the money. So journal entry will be bank account debits to their P&L account. P&L account. This is holding company P&L, their P&L. And subsidiary company pays the dividend. So reserves or P&L, you can say P&L of subsidiary company to bank. Now what entry should group pass? It is to bank, because money is going out. But which amount? What will be the debit? We just discussed. Which will be debited In group books, to bank, correct, debit will be NCI. NCI will be debited. NCI will be debited, which means NCI gets reduced. NCI gets reduced to that extent. Now, logically, why NCI gets reduced? Because group is paying the amount to its shareholders. So when you pay dividend, it's like a payment of liability, that balance will come down. So when you make a payment, you see, in general, you think of any company, you make a payment, in any company, you make a payment, your reserves will come down, because your reserves is on liability side. So you make the payment to the owners. In a way, owners are also outsiders only for the purpose of balance sheet, because balance sheet has dual entity concept. So on asset side, liability side, be it outsiders or owner funds, both are payable only. Share capital also payable back, and reserves also given to back. So when you pay dividend, reserves will come down from normal company balance sheet. But in case of group, when you pay dividend, reserves will not come down fully, because who will receive it? It will be received by another one in the entity only. Are you understanding? I repeat once more. In general, when a company pay dividend, the reserves will come down. But in case of the group, I pay dividend to myself. It's like payable to myself, because even though it is paid out of subsidiary company, it will be received in holding company itself. It is not going out to the extent of holding company share. But outsider shares, NCI will come down. NCI will be on the liability side, we show equity, other equity, NCI. A share capital, other equity, NCI. When you make a payment, that NCI portion will come down. Why other equity is not coming down? Because it is representing the group. This amount is not going out of the group. It is still within the group. So the amount related to the holding company share of dividend is not going out of the group. It will not be having any impact. That's what we have written here anyways. So overall summary of this impact is, when dividend is paid, you can write down, let's write here, when dividend is paid by subsidiary, when dividend is paid by subsidiary, when dividend is paid by subsidiary, when the dividend is paid by subsidiary, dividend related to holding company share, dividend related to holding company share, dividend related to holding company share won't go out of the group, won't go out of the group. And dividend related to NCI will go out of the group, will be paid. Dividend related to NCI will go out of the group, paid out, will go out of the group, and accordingly NCI is reduced. NCI is reduced. See, NCI are like shareholders' funds. When you pay dividend, shareholders' funds will come down, NCI coming down. But for other amount is not coming down, because it's not going out of the group, it is still in the other equity. You can write one note. You can write the note. Dividend related to holding company share of dividend related to holding company share, this one, dividend related to holding company share, dividend to holding company share will be included in. Dividend related to holding company share will be included in. Will be included in. Will be included in. Can you tell me in the balance sheet where it will be indirectly included? I'm not talking about the asset side, I'm talking about liability side. The dividend paid by subsidiary company to the holding company is not going out of the group. So it should be somewhere in the group itself. It's not going out of the group. In the group, where it will be included? It will be included in other equity under the heading CONPL. Are you able to understand? Because to that extent it is not withdrawn from the group. When if holding company also pays out, okay, then it will be subtracted. That you don't worry. So you can write down the dividend related to the holding company share is included in CONPL under other equity. Is included in CONPL under other equity. Is included in CONPL under other equity. But that is not required. I just told you for your reference. Okay, very good. That is last point is not relevant, not important. But what is important is this. NCI is reduced that much. I hope you are very clear, because to that extent the amount is paid out of the group. Hope you got that point. Are you clear? Okay. And due impact on consolidation process. So this is the impact of dividend payment conceptually. Now we'll go for the impact on consolidation process. Impact of dividend. Whenever I say dividend paid, because if it is yet to be paid, either proposed or declared, ignore it. So only about dividend, impact of dividend paid by subsidiary. Impact of dividend on consolidation process. Consolidation process. Consolidation process. Okay. Again, let's understand the holding company books. Subsidiary company books, group books. Okay. Now, okay. First, on date of acquisition, or at the time of acquisition, date of acquisition. On date of acquisition. On date of acquisition. Okay. Regular entry you pass, that I am not going to talk about it. Holding company will pass like investment account debit to bank. I'll not pass the entry, you know it. Holding company will pass regular entry. Subsidiary company will not pass any entry. Group will pass entry for recognizing assets and liabilities at fair value, goodwill and NCI to bank. That basics you know on the date of acquisition. Subsequently, after acquisition, let's say subsequently, let's say subsidiary company makes a profit of post acquisition profit. I'm talking about post acquisition profit. Means in their P&L, post acquisition profit P&L, let's say they make 1 lakh. Now please tell me, for the post acquisition profits, what entry does holding company pass? What entry does holding company pass? For the post acquisition profit, what entry do you pass in the books of holding company? First of all, do you pass any entry in the books of holding company, in their separate financial statements? No entry is passed. For this, no entry. No entry, no effect. No entry is passed for this. Okay. Now, what entry do you pass in group books? Holding company share will be transferred to ConPL and outsider shares will go to NCI. That is, let's say 80%, 20%. Let's say a holding company share in subsidiary, let's say 80% for example purpose. So how are you going to distribute? ConPL $80,000 and then NCI 20,000. NCI 20,000. Now, subsequently, after this, out of this 1 lakh, suppose they say dividend of 10,000, they pay dividend of 10,000. They pay dividend of 10,000. Okay. Now, for this, any entry passed in holding company books, they receive dividend. What entry does holding company pass for receiving dividend? Simple entry. The entry is going to be passed by the holding company books is for receiving dividends. Bank account debit to P&L. How much will they receive? They are going to receive 80,000. 80,000. Simple entry 80,000 because that's what they would have received. 80,000 to P&L account. To P&L. 8,000, sorry, 8,000, correct, 8,000. 8,000. Okay, now what is that we are going to do now? Now please pay attention to this. Please pay attention to this. When P&L account is included here, during consolidation in the group books, we will take holding company P&L account also. Remember, working note format. Subsidiary company one heading, holding company another heading. Under holding company we write investments, below that we write P&L. So even holding company's P&L will come under other equity in other books or ConPL together, you can say, in our column. Now, when you take it into consideration, this profit and loss account is already included 80,000, and when you take 8,000 here again, when you add P&L account of holding company, let's say other profits they have got, let's say holding company has other profits now, holding company business, holding company P&L they made, holding company P&L, their profits, holding company profits, let's say they had 35,000. So totally their holding company P&L will show 43,000. 43,000. Now, should I consider 43,000 in group books? Please tell me. Holding company P&L. 43,000. Do you think it is correct to include holding company P&L 43,000? What is the problem of including holding company P&L? I'll tell you once more. I'm repeating once more. Please answer me. Holding company P&L also will come in groups other equity, and that in the balance sheet when they give in the problem, they will give you holding company P&L which includes the dividend received from the subsidiary company, and you take this as it is in the group books. What is the effect? Exactly, this 8,000 will be a double effect. Why? Because this 8,000 which is part of 10,000, which is part of 1 lakh, which is part of 80,000 distributed 80-20. So this 8,000 is already included in 80,000, which is a duplication. Perfect. Perfect. Therefore, we understood two simple impacts with the previous discussion and with the current discussion. When you pay dividend, NCI balance will reduce, correct? And this dividend is already included in holding company's P&L and in ConPL. If you remove in both the places, this is going to be duplication. It's like intercompany transaction. It's included already and you receive it. It's not really income because you're receiving from the group and group is part of the holding company. The overall process or discussion of entire thing is one simple thing here. In your full-fledged balance sheet, when you do consolidation, holding company would have received some dividend, eliminate. In which column will you eliminate? In a working note column. Now slowly come back to a working note process. In our working note column, where do you subtract? Where do you take this 80,000 into? Where do you take this 8,000 into? Where will these two amounts go? Holding company P&L, subsidiary company's P&L, everything will be going to which column? After allocating it to NCI, it will be transferred to, in a working note, which column? Where do we take this 43,000? To ConPL. So where we should subtract? In ConPL. I'll show you all this working note conclusion, don't worry. I hope you got the point. Let's see if I'm able to show you something. Okay. If you want, you can take down this example, or you would have already taken it down. Then let us go to the graph, the chart, not the graph, the chart part. Chart. You can just mention also that this is duplication. This 8,000 is duplication. Duplication of dividend. Okay, hope it is done. Okay, let me move further. Okay, now what we just discussed so far: dividend paid by subsidiary in subsidiary books, P&L to bank. Reserves balance will reduce in subsidiary company. In holding company books, banks to P&L, reserves and bank balance will increase only to the extent of holding company share. Overall impact on books, no impact to the extent of holding company share, and NCI will be reduced. Journal entry will be NCI account debit to bank, NCI account debit to bank related to NCI share, NCI account debit to bank. This is what we just discussed. Please confirm, is this chart there in the material? The chart book you would have received? It's there, right? Yes, okay. Just take a look at that, or if you want, you can write it, no problem. Or you want to take a picture, whatever you want. Okay. Next, what we discussed in exam problem, what is our analysis? Holding company P&L on the date of consolidation will be including the dividend received, included after creating the dividend received. And during the working notes, CONPL will be added with holding company share of post acquisition profits. Okay, this I'll come to it slightly later. I'll explain you now. I should give one more example. This one point. Impact is double recognition of profits, cash basis dividend received, that is you receive dividend in holding company P&L, and accrual basis you already recognized CONPL. This cash basis dividend received means in holding company P&L. Accrual basis means it's part of CONPL. Based on accrual basis CONPL, we have recognized the profits of subsidiary. We allocated to holding company share to CONPL, outside share to NCI. That is a duplication, double recognition of profits which need to be eliminated. Now what is this working note? I'll explain you. I'm yet to give that example. I'll explain you. After that, you can read this point once more. I hope you understand the process what we are following so far. Double recognition, duplication is the important treatment. Okay. Okay. I hope you are comfortable till here. If you want, you can write down this simple example. Please write down small example. Okay. A Limited acquired 80% of shares of B Limited on 1/4/2018. On this date, B Limited had P&L of rupees 10 lakh. On 31/3/2019, P&L account showed a balance of 16 lakhs. Share capital of B Limited of 10 lakh, and on 1/5/2018, dividend of 10% was paid by subsidiary company. Compute pre-acquisition profits and post-acquisition profits. So what they're telling is, they acquired the shares on 1/4/2018. 1/4/2018. This is the date of acquisition. And P&L account balance, they had P&L balance on 1/4/2018, 10 lakhs. Then on 31/3/2019, year end, P&L showed a balance of 16 lakhs. P&L balance 16 lakhs. And during the year, on 1/5/2018, they paid dividend of 10%. Dividend paid. So 10% means 10% of 10 lakh, 1 lakh. Now, 10 lakh was there. You paid dividend of 1 lakh. P&L balance 16 lakh closing. Now, can you please tell me what is the profits earned during the year? How do you calculate? How do you calculate? How much is profits earned during the year? One method you can do by simply preparing P&L account ledger, or mathematically also you can do. Can you please try first? What is the profit earned during the current year? In this example, 10 lakh was opening, 1 lakh dividend is paid, and closing balance became 16 lakh. It is 7 lakh. So your answer is perfectly right. How it is 7 lakh? 10 lakh minus 1 lakh, 9 lakh. 9 lakh became 16 means 7 lakh. Or if I prepare a P&L accounts for your formats, if I prepare a P&L, by balance brought down, opening balance. By balance brought down, opening balance, which is 10 lakhs. Closing balance carried forward to balance sheet, 2 balance carried down, which is closing balance 16 lakh. And during the year, they paid 2 dividend. which is 1 lakh. So current year net profit by net profit, current year net profit by current year profits, balancing figure 7 lakh. Okay, so this is what you can do ledger method. You can also do mathematical method. From 10 lakh you take out 1 lakh, balance 9 lakh, 9 to 16, 7 lakh. Mathematical is also fine, but for solving problems I will not say both of these things. Both of these things I will not say. I'll follow like this. What is that? What pros we are going to do is this. Our closing balance of 16 lakh is after dividend payment. So first thing what you need to do, reverse the effect. Reverse the effect. So what is going to happen? What is going to happen? So P and L, we had 16 lakhs plus dividend paid. Why plus? It was subtracted when the payment was made. Add back. Reverse. Nullify. Dividend paid. Reverse 1 lakh. So net amount 17 lakh is the profits earned by subsidiary. 16 lakh is the balance remaining because 1 lakh is paid out. But how much profit is earned? 17 lakh. Out of this, how much is opening balance given in the problem? Opening balance is 10 lakhs. And balance current year profits 7 lakh. Balance current year profit 7 lakh. This is what the working note chart I am going to do. Whatever dividend paid, you will add back. Whatever opening balance you calculate, closing balance. That's what 7 lakh here also I am getting. Same answer only. But approach is slightly different. Okay, now let me just show you now how we will write it in our working note. I'll just show it to you in working note format. So we will have something like a subsidiary company, holding company, goodwill, Con PL, NCI. So while computing the share capital, some amount you write it here. Then P and L. In this example, opening balance, current year profits. Opening balance is going to be the amount is 10 lakhs and 80%. So opening balance 10 lakhs, 80%. So 8 lakh goes to goodwill calculation, 2 lakh goes to NCI, and current year profit 7 lakh. So 80%, 5 lakh 60,000 goes to Con PL and 1 lakh 40,000 goes to NCI. And then the dividend paid. Dividend paid. How much is the dividend paid amount? 1 lakh, right? 1 lakh. 1 lakh. And this we will remove 80,000 from Con PL, 20,000 we remove from NCI. This 80,000 is removed because duplication. Why it will be removed? I'll just tell you. Because under holding company column, You will have holding companies P&L, their P&L will you be writing it full amounts? Some amount you will be writing it full amounts. This would be included here, right? So that to avoid this duplication, 80,000 is subtracted. To remove duplication, 80,000 is subtracted. And 20,000 is paid because NCI balance will reduce. So this is to reduce NCI balance. So impact is very simple. You subtract in CONPL, NCI 20,000 will be reduced. And cash balance anyway would have been reduced. When they give you balance sheet, they will give you the post balance sheet at the year end. NCI would have been already reduced, so they would have already considered. But this CONPL would not have been given effect. Therefore, we are going to show this. Can't we net off in current year consider 6 lakh? No, I cannot consider. You can do net year amount, okay, sometimes you can, but that depends on when the dividend is paid. So for that purpose, I would like to show the calculation. I have to show the impact of dividend. So only for that purpose, we have to show separately. Mathematically you can do, but I don't recommend that. Mathematically you can. And one more, people have this opinion, observe, they will be like, sorry, 1 second. Okay, now just look at this. Here on 1/4/2018, P&L balance was 10 lakh, and on 1/5/2018 dividend is paid. So in the AS21 there was this process. In AS21 there was this process. Dividend paid out of opening balance, and opening balance is pre-acquisition. So dividend out of that balance, dividend is also pre-acquisition profits, pre-acquisition dividend. Dividend paid 1 lakh on 1st of May 2018 is out of the opening balance, and opening balance was pre-acquisition profit. So this dividend is also pre-acquisition dividend. That concept was there under AS21. In IND AS, that bifurcation between pre-acquisition, post-acquisition dividend have been ignored. That terminology itself is not there in IND AS world. So whether the dividend is paid out of the opening balance or dividend out of current year profits does not matter. Dividend paid is dividend paid. We don't make any distinction between what is the source of dividend. Is it out of opening balance? Is it out of current year? Is it out of 10 years back? Is it post acquisition? Is it pre-acquisition? No such treatment. It was there in AS21. For those people who know AS21 should not be confused, so I am repeating it. Many people may not know AS21 also. That's a different matter. So pre-acquisition dividend concept is not there in IND AS. So our treatment is very simple. Pre-acquisition profit, post-acquisition profit, everything treatment is same. We are going to do plus a dividend while computing the P&L balance. We reverse the effect. First remove the effect. Entire thing you remove. Then you show whatever the impact that was supposed to be shown. So one impact is plus, other impact is minus. You do plus while doing pre-post division, and you do minus while doing the working note format. Let's see if you are able to understand this sentence now. So this, hope you are able to get it now. Please read this chart. CONPL is added with holding company share of profits. Oh, sorry, CONPL is not this one. No, one more chart. CONPL is added with holding company share. That is already explained. Sorry, this was already explained. Holding company CONPL includes holding company P and also subsidiary company P and also. In holding company P and there is a duplication, which is what we discussed. Now you should look at another chart. Next chart. Look at this one. Dividend paid by subsidiary in exam problems treatment. During the analysis of profits pre-post, P&L of subsidiary given is added back. Whatever may be the dividend paid is added back. Then you subtract the pre-acquisition, balance is post-acquisition. So 16 lakh, you added 1 lakh, became 17 lakh. Subtract pre-acquisition, you subtracted 10 lakh, the balance 7 lakh became post-acquisition. What treatment? In working note, subtract dividend paid, we subtracted 1 lakh. We subtracted holding company share in con-PL column, source does not matter, pre-acquisition, post-acquisition does not matter. NCI share, you subtract in NCI column. Please again, I'll repeat, no distinction, no differentiation, no distinction between pre, post, etc. Same treatment. The moment dividend is paid, you add in one treatment, so you add in one step, you subtract in another step. Actually, in many problems, even if we ignore, answer remains same. I'll tell you mathematically how it happens, but let us not remember, because in some cases it happens, some cases it does not happen. Let's not worry ourselves when is those things and all going to be there. Treatment is simple. You add to remove the dividend effect, you subtract to show the payment effect. You add in P&L pre-post calculation, you subtract in working note, you subtract holding company share in con-PL, you subtract outsider shares in NCI. Okay, so from exam point of view, this much dividend is sufficient. But there is one more small concept, the small difference of opinion is also there. There's something called as a dividend as a recovery of investment. One small concept is there. But from exam point of view, difference of opinion is there. So this is what is required for solving problems. Up to this much is sufficient. We'll take a break and I'll discuss that point also. What is that opinion existing? That opinion I don't recommend you to do in exams, but we'll discuss for conceptual clarity. So take a break of 10 minutes. We are leaving what the standard says. For the discussion purpose, I would not have to take it to the examination part. For that purpose, let me read what the standard says for the interpretation purpose. So this is what IND AS 27 says. An entity shall recognize a dividend from subsidiary, jointly controlled entity or associate in profit and loss in separate financial statements when the right to receive is established. That's all they say. We have discussed this also as per IND AS 27. No separate treatment. Okay. Then there is one paragraph under financial instruments, IND AS 109. These things are not given in the material because this is I don't want to create too much of confusion. I don't want to give too much of materials to you, which is not really relevant for exams or not given. If you want, you can look at the paragraph will be there in the Google, you can go for it. Okay, let's see what the standard says. This paragraph permits an entity to make an irrecoverable election to present in other comprehensive income changes in fair value of an investment entity, instruments that is not held for trading. This election is made on instrument by instrument basis. Amount represented in other comprehensive income shall not be subsequently transferred to profit loss account. However, the entity may transfer cumulative gain or loss within the entity. Okay, this is we are not going to touch upon. Dividend on such investments are recognized in profit loss in accordance with paragraph 5.7.6 unless the dividend clearly represents as a recovery of part of cost of the investments. So they say, let me just focus on this. The dividends are recognized in profit and loss unless it clearly represents a recovery of part of cost of the investments. So if dividend represents as a part of the recovery of the investment, then dividend will go to investment account and not be transferred to P&L accounts. That's what these people are telling. Okay, let me give an example. When will that be considered as recovery of investment? Okay. Please focus this. You would have discussed in SFM also concept of ex-dividend, cum dividend concept. Okay. So let's say on 1st of July 2018, X acquired share. X acquired share at rupees 32 rupees. Then on X acquired shares from Y, let's say from Y. So Y is the transferor, X is the receiver. On 3rd of July 2018, dividend at rupees 2 was paid. Now remember, Y was the shareholder throughout the year. Throughout the year, previous year, till 31st March 2018. And 2 days before, X acquired shares from Y. And dividend is paid. Now tell me, who will receive this dividend? Mr. X, who became a shareholder just 2 days before the date of dividend payment, or Y, the shareholder who was throughout the year? Who will receive the dividend in this case? Which shareholder will receive the dividend? X or Y? Y was the shareholder throughout the year, and X shareholder became shareholder just 2 days before. Everybody is saying yes? X, you're absolutely right. But don't you think it's a very good strategy? Anyway, you will know when company will be paying dividend. Just before that, you go and acquire the share and you receive dividend just by holding the dividend for 2 days, holding the share for 2 days, you receive the money. Good idea, very good investment strategy. But Y is not an Bakra to sell the shares 2 days before when he was the shareholder throughout. You know what he does? When he sells at 32 rupees, it included 2 rupees. So for Mr. X, 2 rupee is not the dividend income, It is a recovery of his investment cost. He paid 32 rupees, which included he paid 2 rupees also. Now he recovered his cost. So what he paid, he recovered. It's a recovery of investment and not a dividend income. Therefore, it should be transferred to investment account and not to P&L. That's what this interpretation says. But this is having quite a few interpretations, because they say this is only if you represent in other comprehensive income. It is not for all category, only if you classify, and it is not for held for trading purpose. So lot of things, lot of difference of opinions and all is there. That's why I'm not including our solution. 1 or 2 points will do, but not at all required for exam purpose. Keep that in mind. Okay, now one important thing. Please tell me this. Please tell me this. Why will know that dividend to include is 2 rupee only? How will Y know? He is selling, he includes, okay, we discussed, but how will Y know that? Dividend of 2 rupee will be included, 2 rupee only will be paid. How does he know future? He is some astrologer. How does he know 2 rupee will be paid? It would be known because, especially for listed companies, a company before making a payment, they should make an announcement. And the moment board of directors propose dividend, then the shareholder will come to know. So, if the dividend was, if the proposed dividend was announced, if announcement was there, if the shareholder is aware of it, but oh, I am paying this amount including dividend, only then it's a recovery of investment. If it was not known, then you can't prove it, because it was not known. And therefore, when will you come to know? Normal course of business, when it ends, you will not be able to know. Usually, when the board of directors make a proposal, after that announcement will go. Board of directors are considering, every news channels will pop up, the newspaper will have it, website will have it. After that, if you purchase, you know my purchase price will include the dividend. Hope you got the point. So in that case, it will be considered as recovery of investment, and in that case it should be transferred to investment account and not to P&L account, when the purchase should have happened between the proposed dividend and before the dividend payment. Again, all these things are practically having difference of opinions, but conceptually recovery of investment works like this. Are you clear on this one till here? Okay. Now, one more question. What is this impact? I'll discuss this. Look at this. Look at this. Subsidiary company books. Starting from, holding company books. Subsidiary company books. Group books. On the date of acquisition. What entry you pass in holding company books? Investment account debit to bank. Correct? No entry we pass in subsidiary company books. In group books, what entry we pass? Assets accounts, goodwill, to liabilities, to NCI to bank the amount of investment made. You know this entry clearly? Very good. Now here, the situation what we're discussing now, please pay attention. Dividend exceptional in the nature of recovery of investment. If you interpret like this, dividend in the nature of recovery of investment. What entry we should pass here? Please tell me. What entry we should pass here? Dividend received. So bank account debits. To what? In the nature of recovery of investment. It should not be transferred to P&L. It should be transferred to investments. Investments. Now, this is interesting. So you don't transfer it to P&L, you transfer it to investment. This amount you paid to bank/investments. This investment account gets adjusted now. Are you able to understand? The corresponding entry in groups books. Corresponding entry in group books. This investment gets adjusted. Investment gets reduced to bank. You're receiving that money. So bank account debits to what? They don't have investment account here. What will happen to this? Can you think of it? First you think logically. Investment amount is getting reduced. What is the formula for goodwill we discussed? Net assets minus investment, investment minus net assets. Investment minus net assets, goodwill calculation, group books, Ind AS 103, at the time of acquisition. In the cost of assets, the cost of investments plus NCI minus net assets. If investment gets reduced, what will happen to goodwill? This will be credited to goodwill account. Means goodwill gets reduced. Goodwill gets reduced means goodwill gets impaired. Means it is reduced. Goodwill is getting reduced. So impairment of goodwill comes. The effect. That's why for exam purpose this is not at all recommended, definitely not required. Exam purpose simple treatment. Dividend comes, take it to P&L, finish. But if you want to have this opinion, which are including charts and also I'm showing it to you. So if the dividend is recovered as investment, it will be transferred to investment account in holding company books and it will be transferred to bank to goodwill in group books. Effectively, goodwill gets reduced because formula for goodwill is investment minus net assets. If investment reduced, goodwill also gets reduced. Now, goodwill is getting reduced means goodwill is getting impaired. Will the standard allows? For that only I have included this paragraph. This is from IND AS 36. 38, 36, 36, IND AS 36, about impairment. Let's see what the standard says. Dividend from subsidiary, jointly controlled entity or associate. For an investment in subsidiary, jointly controlled entity or associate, the investor recognizes dividend from the investment and evidence is available that dividend from investment. When will you do? When the evidence is available that the carrying amount of investment book value in separate financial statement exceeds the carrying amount of consolidated financial statements of the investee's net assets, including the associated goodwill. Meaning what you show investment here and what you show net assets there. That one. Or dividend exceeds the total comprehensive income of subsidiary or jointly controlled entity in the period of dividend is declared. Okay, this is what they say. Don't worry too much about it. What they're trying to tell you is this. If there is a situation like this, when you recover as a cost of investment, and the evidences are available to prove that evidences are available, in that case, goodwill gets impaired, goodwill gets reduced. This is the impact of it. This is the chart. If you want to understand, you can quickly write down. Let's see if I have that chart, I can discuss with you. Okay, let me just go to the chart. Chart is available. If you want, you can write down this example. If you want, I don't recommend because not required for example purpose. But if you want, dividend as a recovery of investment is not relevant. Recovery of investment. What is the meaning? Amount paid by investor includes an element of dividend. When is it considered? When the investor is aware, when the buyer is aware, dividend is available in public domain, like website. Dividend proposed will be announced in news channels, in newspapers, websites. after board of directors meeting, but before it is paid by company. Treatment in separate financial statements, it should be credit to investments. In consolidated financial statements, it should be credit to goodwill. It is considered as impairment of goodwill. During consolidation, what we should do? Okay, during consolidation process, what we should do? If you apply this concept, which I don't recommend, I'll do one problem for a concept, but I don't recommend in examination conditions. If holding company credited the investment, if the holding company did properly, then no treatment required. If the holding company credited to P&L account wrongly, it was supposed to be credit to investments, but they have taken to P&L. So what should happen in P&L? It should be reduced. Please tell me, are you able to understand? If holding company credited this recovery of dividend as investments as transferred to P&L account wrongly, that should be removed from P&L account, meaning in our working out column, con PL should be subtracted. Con PL should be subtracted. And goodwill should be reduced. That's our discussion. Now goodwill should be reduced means in our goodwill column, tell me minus or plus? Goodwill should be reduced. If you apply this treatment, will it be minus or plus? In our calculation working out format, goodwill is a negative number, but if you want to reduce it, it's going to be plus. So subtract in con PL, add in goodwill. You minus in one column, add in plus column. That is if you treat it like a recovery of investment, and if holding company wrongly transferred to P&L. Again, this is, please write against this chart, not for exams. This you don't apply in exams. I'll do one problem on this, but please don't confuse yourself subsequently. When you're revising, when you do many problems, don't do this one. This is only for your conceptual differentiation as how different people look at the treatment differently. For exam purpose, we don't apply this at all. So maybe one problem I'll do, but not subsequently. But all other dividend adjustment will do. But recovery of investments, I'll take only one maybe. Okay, hope you got it. Okay, now summary of all dividend we discussed so far. Dividend proposed or declared means yet to be paid. If dividend is yet to be paid, ignore. See, this is one full chart, summary of full last 1.5 hours of discussion. One chart only. Dividend proposed, declared, ignore. Dividend paid in analysis of profits pre-post, you add back dividend. Pre-acquisition, post-acquisition does not matter. You add back dividend and divide this into pre and post. Holding company share will get subtracted. One addition, one subtraction. Subtract in con PL and NCI share, subtract from NCI. If you consider recovery of investment, again exceptional, not for exams. Exceptional, this not for exams. If you treat recovery of investment, then if investment was credited properly, no adjustment required. If credited to P&L by holding company, rectification entry, that is subtract in con PL and you add in goodwill. You add in goodwill. You add in goodwill. This chart also must be there in your material. Again, you can mention somewhere this recovery of investments, not for exams. The recovery of investments, not for exams. Hope you got it.